As we wind down to the close of 2025, we reflect back on what this year has given to the investor, and it's been precious little. If you look at the scorecard of mutual funds that we've done in the recent past, you'll have seen that your broader market funds have actually underperformed, and those that have performed have actually had a large cap bent. Is that likely to continue in 2026? How should you change your strategy, if at all? And if you had some rank underperformers, what are the metrics that should decide or help you decide to remove them from your portfolio? I'm joined today by Himanshu Kohli, who's a co-founder of Client Associates. Himanshu, thanks so much for taking the time. Let me ask you about that. As you look back at 2025, you will notice that these broader market funds have not done particularly well, and that's why a lot of people are complaining that their portfolios have done nothing. Is that likely to continue into 2026, or do you see a change happening?
So Alex, yes, 2025 has been a difficult year. One, there has been a lot of uncertainty. So Mr. Trump came into power sometime early 2025, and overall there has been an uncertainty. If we see broader asset classes, equity has given a suboptimal returns compared to what it is supposed to give. But within that also, some of the broader market funds, multi-cap funds, they have underperformed because one, mid-cap and small cap was slightly overvalued, while large caps, they were reasonably valued, and large caps have done better in this year compared to small cap and mid caps. And as a result, you have seen some of the large cap funds doing better than the multi cap funds or a mid cap small cap funds also. So I see this was the year of uncertainty. Gold and silver have been clearly outliers. International markets, certain pockets have done very, very well. India, which was performing so well for last 3, 4 years before the beginning of this year, has underperformed this year. And some of these multi-cap funds where there is so much of liquidity coming in thanks to SIPs, they have become more of money managers and just accumulating the AUMs, but underlying performance is becoming weak over there. And I would say I still see mid cap and small cap slightly in the overvalued zone, and this SIPs to continue. So I like the funds which have a certain reasonable size, which can do justice with the client's portfolios. And there are certain pockets which are beyond mutual funds, whether it is PMS or AIFs. They can do far better by being slightly more concentrated and also controlling the tap of money inflow and outflow, because that is something which can really create alpha for clients.
But I don't want to
And
restrict, Himanshu, to mutual funds purely because the people that are tuning into this program are primarily retail investors, and those are the ones that seek the advice the most. So if we restrict ourselves to the mutual fund space, are these trends likely to continue into 2026, or do you see finally that there is a possibility that small cap portfolios, that mid cap portfolios start performing again?
Right. So if we see, there are certain indexes somewhere at the highest level, but number of stocks which are away from their all-time high, they are uh, number of stocks which are away from their all-time high are very high numbers. 70%, 75% stocks are away from their all-time high. They are about 10%, 20%, 30% below their all-time high. Good thing what has happened, Alex, is last 1 year has been a time correction period. Earnings have grown, and now we are seeing the earnings coming back into the system. Second quarter was quite encouraging. Third quarter will be even better encouraging. And next 3 years, we expect the earnings to grow by about 11 to 13% of the broader markets. Now, if that is the trend which continues, I see 2026 will be a better year. One, because valuations have become far better than what they were last year or the beginning of this particular calendar year. And second, if earnings growth starts happening, performance will start coming back. But I will say go for certain funds which are not too large size. If you're going for a large cap, then size may not matter. But if you're going for a multi cap or a mid cap or a small cap fund, maybe go for a fund which is between 1,000 to 3,000 crores. Beyond that, it becomes very difficult to create alpha for the fund manager also.
Okay, fair point. Now, given what you've already said, which is that there is still a little bit of a concern on valuation even in the broader space, but the argument can be made that on the large cap space, at least there's a little bit of comfort even as things stand right now. Would you say that value will still maybe struggle a tad bit in 2026? That in any case, momentum has been missing completely in 2025. Some parts of that might come back in 2026. What are the styles? And I know that it might be too simplistic to say this one will do well, this one might not, because you will have fund managers that use a blend of a couple of these. But what, in your opinion, is the bent of style or strategy that could potentially do well in 2026?
So I would say, Alex, a lot of times we have seen you're driving in a lane and the lane stops and you want to just jump off the lane. And by the time you jump the lane, maybe the earlier lane starts moving. And then you realize you made a mistake. Had you not shifted, it would have been better. Only way you should change the lane is if you see fundamentally there is something wrong. Let's say there is a car broke down
Yeah.
in front of you and that is not going to move. So then you change the lane. Similarly, in investment also, a lot of people they see this fund has not done very well
Yeah.
or this deal has not done very well last 6 months, 12 months. Let me just change the lane and go to the best performing
Yeah.
fund. By the time they shift, that fund stops performing or starts underperforming,
Yeah.
and the earlier one starts outperforming or
That,
starts performing.
That's such a great
So,
analogy, Himanshu. So therefore, let me ask you this, which is ultimately the crux of the conversation, right? Which is that just because something has underperformed in 2025, and there are some that are rank underperformers. I was looking at the performance of flexi-cap funds over the course of 2025, and there's one or two relatively new entrants that have a 19% decline. And that just goes to show that you really have to buckle up if you've chosen wrong, right? And trust in the process. But having said that, there are still some metrics that you would look at, Himanshu, if you were to judge a portfolio, and you probably have less mistakes than a retail investor would make on their own. But what, according to you, are the 3 or 4 metrics that would tell you that you should either stop an SIP or fresh investments into a scheme and let it be, or 2, pull out entirely?
right. So I would say one only reason to change will be if there is some change in the team or the core fund management expertise has changed from there. Second would be if there is something which is not right with a particular institution, then you should look at it. Otherwise, what are the factors, 3 most important factors which I give importance to? One, what is the rolling 3 years performance of the particular scheme? Not point to point or last 3 years, rolling 3 years over last many years, which gives you consistency of the data. If the manager or the scheme is in the top quartile most of the times, and between the top 2 quartiles, 90% of the times, one should just stick over there, even if last 1 year they have been underperformer, but consistency will come back over there. Second, I would also say what is the return per unit of risk which the scheme is giving, because there are 2 R's which are equally important. In fact, returns is something which everyone looks at it on a day-to-day basis because there is a movement in NAV. But what is the risk, which is the other R, which is equally important? So what's the Sharpe ratio which the fund manager is or the scheme is giving for per unit of risk which you are taking? What is the return they have delivered? Or maybe the alpha which they have delivered consistently over a period of time. Third, I would also like to see if one fund manager, let's say, be a top performer, but in certain years or certain 3 years period, they are basically the bottom quartile. Try to avoid someone who is too volatile in their strategy. Try to bring in more consistency. So Sharpe ratio, alpha, these are very important parameters. Are they consistently in the top quartile? And yes, if they have been showing consistency in the top quartile, there is a possibility they will go into the second quartile also sometimes. But if they are too often getting into the fourth quartile also, avoid those schemes. But yes, if the lane has stopped moving or it has not done well in the recent past, last 6 months or so, unless there is something fundamentally wrong with the lane, don't change the lane.
And a Sharpe ratio of above 1 and sometimes heading towards 2 in the case of true outperformers is a great metric, right? So, but having said that, Himanshu, I do want to also ask you, we're heading into the last quarter of the year, financial year, and this is an opportunity to correct mistakes that you might have made in your portfolio selection, right? For more reasons than one. And one of that is that the tax laws allow you to have gains of 1.25 lakh in long-term capital gains in a year that is tax-free. So you can actually book out something that you've held for a long time that has been underperforming, right? And the metrics that you decided are important. Alternatively, you can even book a loss. You can book a loss and you can set that off against future gains. So the question is, should you do that, or should you only pause your SIP and continue in another scheme and shift your allocation?
So first of all, Alex, if you stop and book a loss, just see if there is any exit cost or exit load which you need to pay. Second, you need to see if there is any capital gains which is adverse, which means it's any short-term capital gains. But if that is not the case, and you can stop the SIP, and sometimes booking a loss is better rather than booking a short-term capital gain. So if there is a loss which has happened and you have chosen a wrong scheme, and there is something which is not fundamentally correct, whether it's the consistency of rolling returns, or whether there is a change in the fund management team, or there is some inquiry happening against a particular institution, and you feel fund management team will be busy addressing those queries rather than focusing on the performance, I think maybe cutting a loss and setting it off against the gains will be a better thing. Because sometimes booking a loss helps you save taxes. So saving taxes is as good as money earned also over there. So I am all in for it. Fundamentally, just see if something has gone wrong. Doesn't mean that you don't correct it right now. Even if it's a loss, do it provided you don't end up paying any exit penalties over there.
Okay. Final thoughts, and this is simply the advice that you're giving to your clients and your mutual fund clients specifically heading into 2026. Any ideas that you like, any sectors or themes that you might want, and this is purely from the perspective of tactical or satellite allocation?
Right. So I would also say if there is a feeder funds option which is available, that you can diversify beyond India. Because there is so much of good work which is happening in technology and AI, whether it is in China, whether it is in US, whether it is in Taiwan, and certain markets have been undervalued for quite some time. If there is a feeder fund option available and you can do your SIPs over there, please bring that as a part of the satellite portfolio. Besides your core portfolio, which is going to be between the large, multi, mid, and small cap within India also. Because howsoever India is an attractive basket, putting all your eggs in one basket is not the best of things. If you don't want to look at beyond India, maybe certain sectors which have not done very well, let's say private banks have not done very well, maybe look at doing a SIP into a banking financial services sector also, and build it as a part of the satellite portfolio with a 3 years view.
Okay. All right. On that note, Himanshu, thanks so much for taking the time. I wish you season's greetings from all of us at NDTV Profit, and speak to you really soon.
Thank you. Thank you, Alex, for having me over here. Thank you.
All right, so that brings us to the end of this edition of Your Money Matters, but do stay tuned. More news and updates on the other side.